Yep. So Rakesh, you can start now. We are live on YouTube.
Okay, thank you, Vignesh. Good evening and warm welcome to all our members, past chairperson, esteemed sponsor, and to our chief guest and the esteemed speaker. Being chartered accountant, we all do investment, and today's seminar, Think Smart While Investing in Mutual Fund, will guide us to some of the insightful details of investing in mutual fund, especially what needs to be avoided to have value addition to our portfolio. As we progress, request for certain do's and don'ts to be followed. All participants are requested to mute their video and audio. Question to the speaker to be typed in the chat box only and will be answered at the end of the session. Further question, if any, will be taken offline. We request all DCICI members to type or rename their login as membership number followed by their full name as per ICAI record. Doha chapter members are entitled for structure CPE 2 hours. Now, I would like to invite our chapter chairperson, ever smiling, constantly thinking of doing innovative things, and a strong believer of engage, empower, and enable. CA Nilab Bhatt, over to you, sir.
Thank you, CA Rakesh, for very nice and brief introduction. Am I audible, Rakesh? Can confirm?
Yeah. Yes,
audible.
Thank you. Thank you. Thank you. Respected chief guest, Mr. Hemant Kumar Dwivedi, First Secretary, Culture and Education, Embassy of India at Doha. Speaker of the day, Mr. Anupam Brungta, Certified Financial Planner, representative of various GCC chapters, past chairperson of Doha chapter, and everyone watching us live on the YouTube. A virtual but warm welcome and good evening. It's an honor to welcome you all to this specially designed CP event on the Think Smart While Investing in Mutual Fund conducted by the eminent speaker, Mr. Anupam Brungta, who is joining us from Bangalore. Saving is wise, but investing is profitable. The Richest Man in Babylon is a classic personal finance book written by George S. Clason, and it enumerates key lessons, and one of them is make money work for you. Each dollar you earn is an employee, and your employee should work harder for you. How is it possible? Well, we have an adept speaker to explain the same for us. He will also offer his highly successful program, Mutual Fund Excellence Program, to the interested attendees and members at the concessional rate, about which he will explain. After the conclusion of the event, we will roll out the Google form, and those who are interested to attend the same may please submit their email ID and phone number, which in turn we will submit to Mr. Anupam. This program, I would say, is not talk of the town because it is talk of the country, India, I would say, and many overseas members have also taken the benefit of joining this program, which will commence on this Friday, Saturday, and Sunday. The days are also, I believe, are very convenient to us. To take the proceeding further, we have promised to unfold a surprise during the event, which is our milestone initiative, the first edition of our newsletter, and the name is, can you imagine, can you guess? The name is Doha Connect. It's not connect, it's a connect. And why it is connect that you will see now. Friends, newsletter is the most important tool to further engage and empower members and enhance the branding of the chapter. Doing something for the first time is normally a difficult task, but not when we have a dream team comprising of the ExCom and PR committee members. The newsletter, what you will see now, or rather I would say the glimpse of the newsletter, what you will see now is the result of the tenacious efforts from PR committee member CA Rajiv Modi, CA Suresh Kumar P, CA Priya Suresh Iyer, and CA Aswati, which form our PR committee and which is expertly led by CA Arun Somnath, our ExCom member since many weeks. Great thoughts have been put into right from the selecting the name till its final draft. And this is, I think, 5th or 6th final draft. And a lot of conversation went back and forth between the layout designer and us. Proofreading was done. And now we are extremely grateful to all the authors and contributors who have contributed to this newsletter. and this is not the first time or the single effort. This will continue in its further edition at a varied frequency, and we look forward, every one of you, each one of you, to come forward and make contribution to this newsletter in the future editions as well. In fact, we must thank and say that deep gratitude to all of you, because response to the newsletter was so overwhelming that we have some of the articles which we cannot even accommodate due to the specific length of the newsletter, which also we have to increase from its pre-decided 24 pages. So now what you will see will be 34 to 36 pages. And most importantly, to unveil and launch this newsletter, we have a very, very eminent person amongst us, chief guest of the evening, Mr. Hemant Kumar Dwivedi, First Secretary, Culture and Education, Indian Embassy, Doha. To introduce him briefly, although whole Qatar knows him, I would say, and his name is not unknown to anybody in the Indian community, but to introduce him further, he's the First Secretary, Indian Embassy, and a solid supporter to any of the chapter activity, be it examination or be it recognition of CA as a degree, or being enhancing our ties with IBPC or any of the matter. He is the focal point person. I would say he is our shelter. And whenever we ask anything from Mr. Hemant, we have not been disappointed. Despite being at such a high profile post, Hemant sir is always most importantly accessible and available for each of the ExCom. And I must tell it that it's not only for the current ExCom, it also to the past ExCom and past chairperson. So thank you very much, Hemant sir, for all your support, sir. And it's with the deep sense of gratitude that we again thank you, sir, for being the chief guest of our evening. We really appreciate, and without your constant guidance and without the constant support of His Excellency Dr. Deepak Mittal, Ambassador of India to Qatar, we cannot achieve what we have achieved so far, be it in the matter of examination, in the matter of CA as a degree, be in the matter of QFC MOU. Lot of things we could have done, we are able to do only because of your support, guidance, and patronage. Now I will request you, before I hand over the screen respectfully to you, sir, to please unveil the newsletter. And can I request our chapter secretary, CA Vignesh Kalyan Raman, to please share the screen and let sir unveil it also in a virtual manner. CA Vignesh. So this is the Doha C Connect. I would request all of you to virtually give us a big round of applause to it. Offer your celebratory smiley or emojis, which you can see in the reaction. And again, a deep thanks to our PR committee and ExCom member, especially CA Arun Somnath, who has led the effort. And it's for the first time. But again, I would make an appeal. Everyone, please come forward to contribute to this newsletter, and we will invite you all to write the articles and make your contribution. Can you please go on the second page? So apart from the messages of the chairperson, vice chairperson, and the PR committee representative, we have some interviews from the past chairperson. Thankful to CA George Thomas for interview. And then we have some very, very interesting article, thought-provoking articles, which you may go through. We have an overseas representative also. This is one of the special section where CA Sanawaz Khan, the vice chair of Oman chapter, has written an article on IFRS 17. One of the, I would say, the hallmark of Doha chapter newsletter, which I have learned in the past, is a speaker's corner, where our past speakers, one or two speakers, have given their feedback, introduction, and their views. We have success stories and recent achievement from past chairperson CA Girish Jain, and something about Qatar, some fun, and some glimpses. So we hope that you will like this edition. Formally, we will launch soon in the WhatsApp group, and it will be launched on the website also, and it will be emailed as well. And thank you very much, Hemant sir, for launching it. And now I will respectfully hand over the screen to our chief guest to say a few words, sir.
Thank you so much, Nirlabji, and a warm evening to each of you. Special regards to CA Farid sir, who has been a long standing support and somebody to guide all of us. Actually, for 4 years, almost 4 years, I have been completely into education and culture. But somehow the business connect with the CA chapter of Doha was always through the CA examinations which was conducted. And I'm really elated when I am prepared to wind myself from Doha and move for another assignment in Delhi. Thankful to Mr. Nirlab for giving this opportunity to interact virtually with all of you. I'm really elated to know that Doha chapter has been one of the oldest overseas chapters, founded in 1981, and which has 350 members, something really very convincing. We are really mesmerized with the kind of achievements which the Doha chapter has achieved. And when I see such a programs being conducted, it reminds me of a shloka long back, wherein it is said, na chora haryam, na raj haryam, na bhatri bhagyam, na cha bharkari, ve krite vardhat, evam nityam, vidya dhanam, sarva dhan pradhanam. Vidya is something, knowledge is something which neither the king can take, nor thieves can take, nor there can be no division amongst the brothers, and neither it is heavy. The more you share with your fellows, the more you share with your friends, the better it evolves. And when the CA chapter Doha has really worked so hard, tirelessly to ensure that the education, CA as an education, is spread, awareness is spread, many are able to take their examinations seamlessly. Our contribution, the embassy's contribution, is very little vis-a-vis comparison to the hard work and the tireless work which is being done by Doha chapter Doha, CA chapter Doha. I'll request a big round of applause for each of you. Wonderful. Not only this, CA examinations which are done here in Doha, we have gradually evolved ourselves from conducting initially in premises of ICC to a school Birla and now to the MES. It has seen its own light of the day, and I'm very sure when I leave, it will be a satisfactory stint because we have been able to regularize something which not only shapes the career of many, but also spreads awareness. And the growth in the membership, the upward trend of the number of aspirants who are writing their examinations from Doha, that speaks volume of how each of you have really made efforts for the awareness amongst somebody who is not CA qualified. I reckon there are certain issues with the CA as a degree, and as Mr. Nirlab has mentioned, the embassy will lend all its support to ensure that the issues are well taken care and it is resolved amicably as per the resolve and as per the dictates and as per the requirements what the CA chapter Doha and many other overseas chapter and back in India look for. While I may move from Doha for good, I wish everybody good luck, especially the CA chapter Doha. And I firmly believe the best is still to come. The leadership is dynamic, and certainly our good wishes in all your endeavors. Wonderful. Thank you so much.
Thank you so much, sir, for your words of wisdom. And we look forward to your blessings, continuous blessing. And yeah, and please stay. We have a very interesting program. Over to you, C. Arun Somanath, to take the proceedings further.
Thank you, CA Nirlab. Respected Hemant sir, respected members, a very warm good evening to everyone. It's my privilege to introduce the speaker of the day, who will help us in minting money through his investment ideas and experience. Anupam helping people with investment strategies, stock market, and mutual funds for over 10 years now. Over 14 years of experience in varied fields like Indian equity market, mutual funds, startup consulting and funding, real estate, insurance, and business research and advisory helped him gain various perspectives. He grew up seeing his father reading annual reports, journals, and business newspapers. His father started investing way back in 1978, and this is where he got this idea, and he started his investment journey as well. Subconsciously, he was learning about markets, investment, compounding, etc. from his father. The best decision of his life, he started investing from his very first paycheck back in 2006. Stock investments made him and his family financially free, and this is one of the major reasons he is in this field. He loves doing stock and mutual fund analysis, and it makes him happy to share his learning with the investors. That is why he took this as his profession. With big round of applause, I request everyone to please help me in inviting Mr. Anupam to please enlighten all of us about investment in mutual funds and many other areas. The screen is all yours.
Thank you, Arun. Thank you, Nirlep and team. I'm glad to be here with the chapter of ICAI chapter of Doha, and I hope the next 1.5 hours or so will be fruitful for everyone. I'll just share my screen. Give me a second. All right. Can you all see my screen, and is my voice loud and clear?
Yeah, we can see your screen. If you could just make it full screen, Anupam.
Yeah, the slideshow mode, I'll do that. Now it's fine,
Yeah.
right?
Yeah, it's perfect.
Perfect. All right. Cool. So Arun has already given my introduction. I'll just briefly share a couple of things. I would like to repeat. I'm a SEBI registered research analyst and also a certified financial planner. I run the blog in my name, that is anupamrungta.com, and we are broadly into two verticals. One is education side, where we do programs on mutual funds and stock market. We basically train investors on how to build their portfolios, and the other is the stock advisory service. I'll just put a break to my introduction here. I'll suggest you go on my website after the session, and you can see read more about our work. So I'll just start straight away with the session today. So at the topic, you all know, think smart while investing in mutual funds. So basically, I'll share a few nuggets with you, few pointers with you, which you can look at while selecting a mutual fund scheme. And maybe you can look at your current portfolio and see if anything is missing there with respect to what you learned today. After today's session, there are 3 takeaways or 3 secrets of mutual funds which you will take away with you. The number 1 is you can earn at least rupees 1 crore more by gaining expertise in mutual funds. Now, what exactly it means, I'll just allow me some time and I'll take you through that. The second one is looking at past performance of a scheme beyond 10 years is meaningless. Now, what does it mean? There are few mutual fund schemes available in the market which were launched like 20 years back, 15 years back, 25 years back, and their performance, their returns on an average compounded annually is 18, 19, 20%, which is amazing, which is like a superstar performance. But I am saying it is meaningless to look at performance beyond 10 years. All I'm saying is you should not get impressed or influenced by those numbers. Rather, we should look at a more recent data, and I'll talk more about that in the session. The third takeaway or secret is very few fund managers are investing their own money in the funds they manage. Now, fund manager is basically the topmost guy of any mutual fund scheme. He's the one who is responsible for taking the final decisions on which stocks to invest into, what proportion, and how to go about it. Now, if that person himself or herself is not investing their own savings into that particular scheme, it does make me a little uncomfortable. Yeah. So we'll look into that. And I'll also share one good news with this aspect. There's a new law by SEBI. We'll talk about that as well. A couple of disclaimers. This session, as you know, is only for education purpose. For doing a complete analysis on mutual funds, 1 hour or 1.5 hour of session is not enough. So please take it from an education point of view. I will talk about a few sectors and schemes here and there, but don't take it as advice to buy, sell, or hold. So please don't do that. And starting from right now, the session will go on for about 1.5 hours, including the Q&A. So after every topic, I'll give you time to write your questions in the chat box, and I'll keep on answering them. I may not be able to answer all the questions in the interim. So in the end, I'll take up the Q&A again. If there are more questions, I'll do my best to answer all the questions as far as possible. Yeah. First one, past performance. Just look at this chart, this table. I'm saying the NAV of a mutual fund scheme. NAV is what? The way you have stock price, and similarly you have NAV, the price at which you buy a mutual fund scheme. The NAV of a mutual fund scheme in year 2000 was 100, and it grew by 18% compounded annually. The returns were 18% in last 20 years, and today it is 2,700 odd, right? Let's assume everything else has been taken care of. All the parameters you have looked at and they are fine, right? Will you invest in this scheme? Write a yes or no in the chat box. Just looking at this parameter, assuming everything else has been taken care of, will you invest in this scheme looking at this parameter? What is your call? Yes, no. Okay, getting both kinds of answers. I'm repeating, I'm assuming everything else has been taken care of. All the other parameters have been taken care of. In that case, will you invest in this scheme? All right, I've got both yes and no. Let me give you one more data point. The returns in this scheme for first 10 years was 27% compounded annual, and the recent 10 years is 9.7% compounded annually. Now, those who said yes, do you think you will now consider investing in the scheme? Now the answer is no, right? So the point here is, in the last few years, and that this happens like almost all the time, especially in the last few years, a lot of regulations have come up from SEBI. The way mutual fund industry is supposed to work, the kind of restrictions on fund managers and the way they can invest. Plus, in general, the business environment changes, the business dynamic changes, the way a business performs, transforms over a period of 10 years and beyond. Moreover, the fund manager of the scheme changes. So maybe in the first 10 years, I think there is, it's not for everyone.
Mute Mr. Suresh. CS Suresh.
So the first 10 years were even better for the scheme. The returns were 27%. Last 10 years have not been so good. I was talking about the SEBI regulations and other changes in the business environment, plus the change of the fund manager himself. So maybe the fund manager who was there in the first 10 years did very well. And now, after the fund manager changed, the fund started, going down the hill. Now, what's important for you to look at is, let me show you one example, then I explain you more about how many years is the ideal time to look at. Let's look at the scheme called DSP Top 100. Just look at this left-hand side I'm highlighting. This was launched in March 2003, so more than 18 years back, right? Now look at the right-hand side, I'm highlighting again. The CAGR since inception is 19.91%, almost 20%. So 20% compounded annual returns for last 18 years, right? Looks very exciting and very impressive. Now let's go down and look at this. The last 10-year returns is only 10.73%. Not too bad, but nowhere compared to what we are looking at last 18 years returns, right? So the first 7 or 8 years of the scheme were brilliant. The returns were much higher compared to what they've done in the last 10 years. And because their returns in the first 7-8 years were so good, that even the 18-year returns looks very impressive, right? Now, coming to the point again, ideally, looking at last 5-year returns is the best thing to do. It's not a very long-term game. It's not like 8, 10, 12, 13, 14 years kind of a thing. And it's not very short-term also that you're, judging the performance of fund manager or the scheme in a year or year's time or 2 years time or 3 months time or 6 months time, right? So look at 5-year return. Now, a natural question on this can be, why not 1 and 3 years? What's the problem with 1 and 3 years? So let me share one more data point with you, which will give you some perspective to this. Look at this slide. We have chosen equity large cap. That's the large cap category. And we're looking at 1 year return, right? So ranking as per 1 year. If you look at this first scheme, Franklin India Blue Chip Fund, the returns in last 1 year has been 56.12% return. So if you invested, for example, 10 lakh rupees in this scheme, exactly 1 year from now, 1 year back, the value of the fund will be 15.6 lakhs today. Value of your investment will be 15.6 lakhs. This is rank number 1 in the category in 1 year table, right? Now look at the rank of the scheme in 3 years. It's 8 out of 30, right? And the best part, look at the rank of the scheme in 5 year thing. It's 25 out of 29. So the problem here is most likely that's how it looks like. The fund manager got lucky in the last 1 year. And I don't want to invest my money on luck. I want to see some level of consistency in the performance of the scheme. I'm not looking at a scheme performing every year, but I am rather looking at a scheme which can perform consistently over a period of say 5 years. But that really shows the kind of caliber and the kind of knowledge and skill the fund manager has got. Last 1 year or last 6 months or even last 3 years can turn out to be lucky for some and unlucky for some. Right? But the luck cannot go for 5 years. It's unlikely. Yeah. And having said that, this is not the only parameter. But when we are looking at the past performance of a scheme, then looking at 5 years is the most ideal thing to do, because we are neither looking at a very long time period, nor we are looking at like 6 months, 1 year or 3 year period. Yeah. I hope that made sense. So last 1 year basically can make it look biased. That's my point. Now, I'm not saying the scheme I showed you right now, the Franklin scheme, will not do well in next 1 year, 2 year, 3 year. It may do well in future as well. But there are so many options available in the market. I would like to be a bit stringent when it comes to putting my money into a scheme, because I have that flexibility with me. So I would like to be a bit stringent and choose a scheme which will fulfill all the parameters I'm comfortable with. So I can be a little strict, and it's okay, because I will find schemes even after being strict with them. Yeah. Any queries you have on this concept so far? Are you clear that why you should not look at very long term and why you should look at 5 year period? Any particular conceptual question you have on this? Is a couple of people are saying voice is lagging and breaking. I hope it is fine now. Suresh said it is fine. Any questions on this? Else I'll move to the next topic. I can maybe take up your questions after this topic as well. But I'll wait for a couple of seconds, 5 to 10 seconds maybe. When you switch schemes, we also need to take into account capital gain tax. You're right, Ramesh. The point is, I definitely want to reduce my taxation. I don't want to keep on switching to a different scheme and paying that capital gain tax, be it short or long term. But having said that, let's say I'm investing in a scheme which gives me 13% returns, and I exit and I pay 10% long-term capital gain tax. Rather than that, I stick to the scheme to save that 10% on taxation, and my returns drops to 7 or 8%. So I am better off, paying the tax on the 13% return and moving to the next scheme as per my parameters, rather than just saving the tax. So saving tax is important, no doubt about that. But that's like one aspect of the investment, not the only and the most important one. Right? So we have to look at both the things in a balanced way. I totally agree that the taxation is very important, and in terms of it impacts your compounding to a large extent, for sure. And in my experience, when we are looking at a portfolio of mutual fund schemes for 4 to 6 schemes in a portfolio, the churning is actually very less. It's not much. It's not very frequent that a scheme which is performing good right now, and we've checked all the fundamental parameters, it will suddenly become very bad next year. It's rare, right? So the churning is actually very less. All right, let me move forward. Next topic. Now, when you look at mutual funds, there are various categories within them. For example, large cap mutual fund schemes, mid cap, small cap, then you have sectoral schemes, you have dividend yield funds, you have contra funds. So it is natural to get overwhelmed sometimes that, which scheme to invest into and why to avoid something, why not to avoid something. So let me tell you the categories which you can definitely avoid without, worrying about that you will miss out on something. Yeah. So the first one, and the most favorite one of most of the investors, sectoral funds. I am suggesting you to avoid sectoral funds. And let me give you the reasons behind that. The first question you need to ask yourself when you're investing in a sectoral scheme is, sectoral fund example means, for example, a pharma sector fund or technology sector fund or an automobile sector fund. So basically, most of the money, or more than 80% of the money, your money will go into the stocks of that particular sector. That's a sectoral fund. Right. The first question you need to ask yourself is, do you know this sector well? Let's say you are working in IT company or tech company or pharma company for the last 10, 15, 20 years, and you say, I know this industry really well. I know the in and out, I know the challenges, I know the competition, I know the margins. I understand this industry, this business. Now, my next question in this case would be, if you really know this sector well, why do you want to invest in 18, 20, 25 stocks of this industry? Why don't you pick up 1 or 2 stocks and invest in them and make your money? If you understand this sector very well. Yeah, because when you invest in a sectoral fund, it's investing in 20, 22, 25 stocks. And no matter how good the sector is supposed to do, all the stocks are not supposed to perform. It has never happened. It's not possible because there's competition. Simple reason, right? So just because a sector is doing well does not mean every stock or most of the stocks in the sector will do well. No, you will make losses also in that sector, in some of the stocks. Yeah. So the first question is this, that you should know the sector well. If you don't know the sector well yourself, then that's a good enough reason to stay away from it. Yeah. Second point, understand this logic. Let's say there is a mid-cap fund, a typical, simple, pure mid-cap fund, where the fund manager has invested in, let's say, 60 stocks, and 60 stocks across various categories, automobile, various sectors. He has invested in automobile also, pharma also, tech also, infrastructure, so banking, so all the sectors put together. He has formed a portfolio of 60 stocks. Now, in his research, fund manager finds out that auto sector might not do very well for next few years, because of whatever fundamental reasons he found out in his research. And there are 3 stocks in this scheme which are in the auto sector. What can the fund manager do? Simply, he can sell those 3 stocks and invest money in other stocks. Yeah, very simple exercise. That's what the fund manager is supposed to do. But if it's an auto sector scheme itself, the fund manager or the mutual fund company or the management will never come out in the market and say that we don't expect this sector to do well, so we are closing the scheme. Please understand, please put yourself in their shoes. Their business, the business of selling mutual fund schemes. They are supposed to launch as many variety of schemes as possible, so that someone will buy something, someone else will buy something else, and they are able to sell as much as they want to, or as much as they can, right? So the fund manager will never come out authentically and say that, we don't believe in this sector anymore, so we are closing the scheme and returning your money. You have made good money so far, good, now take your money back. We'll never do that. Please understand this psyche. The next point, I'm saying, do not look at sector when you're investing in stocks and mutual funds. And let me give you a couple of reasons for this. Look at telecom industry. In last 20 years, I think telecom industry is one industry which has grown by leaps and bounds. It is like the most grown industry in last 20 years. Look at the way mobile phones came in late 90s and early 2000. It was a luxury, right? Very, very few had it. Now it has become a necessity. Every family member has a mobile phone. Even teenagers have got a mobile phone today, and every month you pay the bills. Right, so this has been a transformation across the world and in India as well. But look at the performance of telecom stocks. If you ask any expert in 2000, 2001, 2002, 3 and 4, they would have said telecom is a very good sector to invest in next few years, and they were right. I mean, looking at the growth and looking at the way the world was moving, it was a very rational thing to say that telecom is a good sector to invest in. But look at the performance of the stocks. Companies which came from outside India, they have gone back. Companies in India have gone bankrupt. Mergers have happened, and still they are losing money every day. Why? Because of high regulations, all that 2G, 3G, 4G spectrum, and the capital intensity of the business and the competition. Just because a sector is doing well, forget about having a few stocks which do well. There can be a possibility that none of the stocks do well. Second example. I remember in 90s, going out for a vacation, more than 50% of the time it meant going to a town or a city where we have a relative, and we'll go and stay with them in their house, right? It was a very typical scenario. Now, look at the kind of vacations you do pre-COVID, and I'm sure we'll get back to that. So the kind of vacations we do now, whether we have some known person in that city or not, you prefer to stay in a 4-star or a 5-star hotel. Look at the quality of your vacation. Look at the kind of money you spend. Look at the kind of the frequency of vacations now compared to what it was 20-25 years back. Right now, given that, look at the stocks in hospitality sector, the last 20 years performance. Why have they not performed? Again, competition and capital intensity. So the point is, just because the sector is doing well, it does not necessarily mean that the stocks are supposed to do well. So please, having said that, the way sector funds move up, they move down also in the same way. The way it moves up by twice or thrice or 4 times, it goes down also to 20 or 30% or 40% of value within a few weeks and few months, and you will not even get to know when it happened. Right. And the last one more thing. You may still say many experts are were suggesting, let's say in last 6 months or 1 year, and are still suggesting a few sectors. For example, pharma sector or tech sector. They are saying that this sector is bound to do well, and they have their very simple logic, and it's common sense, right? Please understand one thing. If it was possible to just follow what experts are saying, whoever it is, I'm not saying that they are wrong or right. I'm saying if it was possible to just follow what experts are saying, whoever that expert is, and invest in sector funds each time through 10, 15, 20, 30 years of your investing life and make money in the process. If that was possible, then there would have been no poverty in the world, and not in India also. Because everyone would just follow what the expert is saying, invest as per them in the particular sector, take out money when they say take out money. And I mean, having said that, there are like multiple people saying multiple things. 10 experts will say this sector will do well, 10 will say this will not do well. First of all, whom do you follow? Right. Secondly, even if you follow someone, how long can you really have conviction in their suggestions or recommendations? Last point. Those who actually invested in pharma or tech sector in last 6 months and 1 year, and they have made good money and they're happy about it, just ask yourself and see for your portfolio that how much have you invested in percentage form of your total portfolio size. How much did you invest? Because that will tell you the level of conviction you have in that expert. Because if you had a portfolio of, let's say, 50 lakhs and invested 1, 2 or 3 or 5 lakhs in a particular sector, and that has become double, not bad. It's good money. But that does not really make a huge difference to your portfolio. Why? Because you did not invest a sizable chunk. So, agar karna hai investment, if you really are confident about something, then invest really well. Else, please stay away from sectoral funds. It's good to invest in pure large cap, pure mid cap, and pure small cap categories where the fund manager has got flexibility to choose various sectors. You give them flexibility. Yeah. Next point. Dividend yield fund. So dividend is what the companies give. It's a choice whether they want to give dividends or not. But there are some companies which give very high dividend compared to other competitors in the same industry. So dividend yield fund basically invest in those stocks which usually give very high dividend, right? So that's the notion behind forming a dividend yield fund and investing only in those stocks which are giving good dividend. Let's look at okay, before I do that, I missed on one point. Let's go to one of the examples of sectoral funds. I'll show you one of the data points here. So the name of the sectoral fund is SBI Healthcare Opportunities Fund, right? The name suggests very clearly it's a healthcare fund. So they will invest in pharma and healthcare industry, healthcare stocks. Look at the number of stocks, 24 stocks. Let's look at the names. Some of the names: Dr. Reddy's Lab, Aurobindo Pharma, Sun Pharma, Cipla, Divi's Lab, Lupin, Alchem, Narayan Hyderalaya, Apollo, Max, Gland Pharma, Strides, JP Chemicals. Almost every stock is there. What's the point? What makes you think that every stock will perform? No, it may give. I mean, this sector may give more returns than maybe other sectors, but the way it will go, as I said, the way it will go up, it will come down also in the same way. Yeah. So what's the point of investing in 24 stocks in a particular sector? If you really know the sector well, invest in 1 or 2 stocks. If you know the sector well, if you don't know any sector well, it's good news. You're not supposed to know the sectors in the stock market and the business. You're supposed to do your work, and you're supposed to give the way you are an expert and professional in a particular field. There are other professionals in other field. Let the fund manager do their job. Why are you doing fund manager's job? By choosing sectors. Yeah. Second, dividend yield fund. Let's look at an example of this. So total, we have 8 schemes only in this category, which is very less. So I don't have enough comparison to do, right? And having said that, let's look at 5-year returns. Look at this: 16.49%, 15.57, 5.15, 12, and 11%. So these are the returns of dividend yield funds in last 5 years. These are top 4-5 schemes. Now, if you look at any other category, let's say if I look at equity mid cap, for example, if I look at their 5-year return, this will give you some perspective. Now look at their returns: 19.48, 19.31, 18.76, 18.1, 17.7, 17. So the first 7-8 schemes are giving more returns than the top scheme of dividend yield fund. So it's not that just because a company is giving more dividend means it is a better company and it will give you more returns and that scheme will give you higher returns. No. It is giving, and this is not like only now. You can check this performance at any point in time. This dividend yield category of fund will always give less return a pure mid cap or a pure small cap or a pure large cap fund also. Another very interesting category, value funds. You must have heard value investing. In simple terms, what value investing is, you're looking at stocks which have low valuation. Basically, they are coming for cheap in the market, and because they're coming for cheap and you believe the stock is good or the company is good, you expect the stocks to go up in the next few months and few years, right? So the return through value funds or through value investing is supposed to be higher compared to any other form of investing. Let's look at the returns. So value fund should give you more returns, right? So let's look at this. 5 years. Look at the returns: 16.31, 15.32, 14.74, 14.08, 14. Again, I mean, I showed you the mid cap fund, a mid cap category, and you can look at this one. Why are they not giving returns? Because you have constrained the fund manager. That, you know, ये particular P ratio के stocks में invest करो या particular kind of stocks में invest करो. You're not giving them flexibility. Why are you binding the fund manager? It's your hard-earned money. Why are you going against your own fund manager? And they sell it because they're in the business of doing it. But you, as an investor, you should be aware what you're doing to your own money. Contra fund, as the name suggests, it's contradictory. So basically, the fund manager will take contradictory calls. Example, ITC stock is not doing well for quite some time. The fund manager might say that, you know, I still believe in this company and the growth and the fundamentals, and it is out of favor in the market right now. It's like a contradiction to invest in ITC right now. So I will go and invest in ITC stock. That's called contra investing. So all the fund will have all the the contradictory kind of or out of favor kind of stocks. Same story with their returns. Another very interesting category, thematic funds, and I believe the most ridiculous kind of funds available in the market. Let me show you something in this. You should maintain social distance from thematic funds for sure. Look at this. Within thematic, you have thematic consumption. So they will invest in consumption-driven stocks. For example, Pidilite, Nestle, HUL, Britannia. You know, all those consumer-driven stocks. Energy, all energy and power companies, international companies, thematic MNC. All those companies, they are actually MNCs. So they will not invest in a company which is based only in India. They will invest in a company which has offices in multiple locations across the globe. So they will invest only in MNC companies. It's like a joke. Thematic PSU, only PSU government companies. Why are you doing this? This is my hard-earned money. This is not some fancy dress competition where I will do theme investing. Theme-based fancy dress competition or theme-based investing doesn't make sense at all. Doesn't give you returns. Yeah, so all these categories you can see here, I call them fancy categories. They look nice on your portfolio, but I mean, this is all that pasta, pizza, and burger. That's what I call them, which you know is not good for health, right? Have your simple dal, roti, and sabji. Large cap, mid cap, and small cap, you know, put in a very simple way, and you will make your returns. They all look attractive. You know, you feel you get the desire to have them. But please stay away. Not good for your health, physical health and your financial health. Yeah. Any questions on this? Let me look at the chat box. Would investing in banking and financial sector funds, which have exposure across wide sector of economy, be as good as a diversified fund? Ramesh, I would not say. I will still. I mean, still a sectoral fund. Please understand, banking and financial services. I understand there are many companies, but even the scheme will have many stocks. It's not that scheme is investing in only 5, 10, or 8 good stocks in that industry. They're investing in 15, 20, 25 stocks. The point is, when you're investing in a, let's say, small cap or a mid cap or a large cap mutual fund scheme, even they have got exposure to banking and financial services sector. And again, I repeat, it may sound very logical and common sense to invest in a few sectors sitting today. You know, tech sector will definitely do well. Banking sector will definitely do well. Or pharma sector will definitely do well. But we never get to know when they hit the wall and they start falling. You get to know only when the fall happens. Advance mein nahi pata lagta. Yeah. So I'll suggest to stay away. What about Nasdaq funds or US based funds or funds? Okay, see, funds of funds, I'll again ask you to stay away. Funds of fund is what? You have a portfolio of mutual fund schemes and you are buying that fund which is having various mutual fund schemes in itself. So that's like they're having, they are giving the portfolio, ready-made portfolio, but you're paying the expense ratio twice. You're paying the charges twice. I won't be able to take that in detail, but I'll again suggest please avoid that. International funds, I can share a few of my view on international investing. In my view, the kind of growth we have in India, I don't see that in most of the countries of the across the world, no matter what. Right now, एक कहावत you might have, I believe all of you know Hindi, so you must have heard "Ghar ki murgi dal barabar." Right, so we all like foreign stuff, foreign stocks, and this and that. When we don't believe in our own country as much as the foreign institutions believe. Yeah, so I have seen retail investors that have a certain pattern of investing. Let's say mid cap and small cap schemes are doing well, or mid cap and small cap stocks are doing well. Everyone will go behind mid cap and small cap. From Jan 18 till Jan 20, for those about 2 years, only large cap was doing well. Mid cap and small cap, most of the stocks did not perform. So everyone started saying this mid cap and small cap is useless. Just invest in high quality, big companies, blue chip companies, and you will do well. Right now, in the last couple of 2 or 3 years, again the foreign stocks are doing well. Google, Facebook, and all these Netflix and all these foreign names. So again, everyone's like, no, we should have diversification in international stocks. Why they started only in last 2 years? Why were you not talking about 10 years back or 5 years back? Because that trend has come now. It's more of a fashion or a fad, right? So we retail investors typically start investing in a particular category or particular kind of investments when when we see returns in last couple of years. I'm not saying it's a bad thing to do. All I'm saying is that's not really the best way to form your portfolio and invest. Right, and the kind of returns we have in India, just look at the way all the companies are coming and establishing here. Walmart is coming here. You saw the kind of returns, kind of investments Reliance got last year during the lockdown. They were not investing in Reliance. They were investing in India. They were investing in Indian story. And we want to go out and invest. Again, I'm repeating. I'm not saying foreign stocks will not do well or foreign international schemes will not do well. They may. But I'm sure my Indian schemes will do much better in the long run. Yeah, so that's my view on international. And when you're investing in international schemes, by the way, you're also exposing yourself to dollar fluctuation. So please be careful about that as well. Look at a few more questions. Any examples of EV, green or clean energy focused mutual funds? So again, I'll recommend don't go behind that. Again, a lot of people are talking about batteries and electronic vehicles. So definitely this sector will do well. I also see that happening, but that does not necessarily mean that there has to be a few stocks or schemes which will do well in this sector. Because there could be very high intense competition in this sector, which will lead to no one making money, no one making huge money. Yeah. Look at the example of sanitizers. 1.5 years back, how many of you were using sanitizers on a daily basis or on a weekly basis or a monthly basis? And how many of you use sanitizers today and how frequently do you use? Can you name me one company which has become a multi-billion-dollar company because of sanitizers? There is none. Why? Because thousands of brands have come and launched sanitizers. Even Panwala will have a few dubbies of those sanitizers. So because so much competition comes in, because the sector is expected to do well, so much competition comes in that no one is able to make huge wealth. Yep. Return on dollar basis is high as rupee always goes down against dollar due to interest rate parity. Surya, you're right. That's what has happened so far. But I mean, based on that, I would still not invest. And in my view, if I look at long 10, 15, 20 years of returns, even after adjusting for dollar returns for Indian stocks and Indian mutual fund schemes has been higher than foreign stocks and foreign schemes. That's what my observation has been so far. Fund performance is cyclical. Blue chip did well earlier. Now it is small cap and mid cap are doing well. So Rajesh, I would say yes, it may look cyclical, but please don't try to time the market accordingly. Don't do this timing. Rather invest across the three categories and invest for your long term as per your financial goals. Sometimes mid cap will do well, sometimes large cap will do well, sometimes small cap will do well, but overall your portfolio will do well. That's what is important. If you try to time the market right now, let me invest in mid cap, small cap, then I will get to know when it is not performing. I'll get out and enter in large cap. It doesn't work like that. In the retrospect, it is easy to say, if I invested in those 2 years in mid cap and those 2 years in large cap, I would have done that. But in practicality, it is not possible to really find out when to enter, when to exit. And timing market is anyway not a good strategy to have. Yeah. All right. I think I've kind of answered most of them. How do you time your exit? From Hari Krishna? I think I answered your question now. I just said that I suggest you not to time the market. Don't time that. Don't do that. Yeah, just because returns are good, so let me book the profit and go move ahead. Don't do that. That's another not a very good strategy to have. Amrik, you're asking a similar question. I'm taking the last question, then I'll move to the next slide. If the invested fund performs far higher than expectations in short term, is it a good idea to exit or continue? So Amrik, the point is, why did you invest in that sector at the first place? And what research did you do? And do you believe in that sector going forward? I mean, if you're investing in a particular sector or a scheme, whatever the scheme is. But just because it has given good returns in the past does not mean that you should not continue your investment. So just look at it like this. We typically look at last 5 years of returns, as I was suggesting you a few minutes back. Look at last 5 years of returns of a scheme and then invest in that. Let's say everything else has been taken care of. But at the same time, if there is someone who has been investing in that scheme for last 5 years, he or she wants to exit, saying that when I profit earlier, let me exit this scheme. So at one place, you're exiting that scheme, which has given you good returns. At the same time, you're entering that scheme, which has given good returns to other investors. So it's like, you know, it's a counterintuitive. Anyway, let's move forward. I hope that made sense. How many of you do not know what is regular versus direct plans? I believe a lot of you would know, but it is still a relatively new concept. It is gaining traction now. People are getting to know now. How many of you do not know what is direct plan versus regular? What is a direct plan? You can write an I in the chat box. It's okay. Be proud. Nothing wrong or right in knowing it. Okay, it seems everyone knows that. Good. But I'll give you some. I hope I'll be able to give you some insights on this. So regular plan is when you buy, when you deal with an advisor or an agent or a distributor. MFD is mutual fund distributor, right? So even your bank or your brokerage house, let's say you have an account with SDFC Bank, and your relationship manager is, managing your mutual fund portfolio. That is a regular plan, where the mutual fund, that relationship manager or the branch is your mediator. Even let's say you have a demat account with ICICI Securities, SDFC Securities, Kotak Securities, and there you have some wealth management department who is managing your mutual fund account. They are also investing your money in regular plan. Now, the TER, what is TER? Total expense ratio. In simple terms, it's the charges that you pay to the mutual fund company every year. So TER of a regular plan is higher by about 1% because the commission goes to that intermediary, be the advisor, broker, agent, or distributor, right? Whereas in a direct plan, you can directly buy from the fund house. Let's say you will go to sdfcmutualfund.com or kotakmutualfund.com, or there are various other platforms from which you can buy that. I'll talk about the platforms in the next couple of slides. एक example से समझाते हैं. एक example लेते हैं, Motilal Oswal Mid Cap 30 Fund. Let's look at the difference in the expense ratio for this particular plan. So right now it is regular plan selected. I'll go down and check expense ratio of this scheme. Look at this expense ratio, right hand side I'm highlighting, it is 2.1%. So basically in simple terms, 2.1% is the annualized charges which you are incurring by investing in the scheme. If you're investing 100 rupees in the scheme, 2.1 rupees is getting deducted over a period of 1 year gradually, and remaining 97.9% rupees is getting invested. Actually investment is happening in the scheme. Right? This is what expense ratio means. Now, if I change it to direct plan, every scheme has both regular and direct plan, right? So same scheme, if I look at direct plan expense ratio, it is 0.87%, right? And just I'm highlighting. So 1.23% gap, right? So typically it is 1% gap. It can be less than that. It can be a little more than that, but typically it is 1% gap. But in this case, you can see it is 1.23%. Now, just to explain you further, what's the difference? There is no difference in the scheme per se. The only difference is whether you have a mediator or not. Example, you're doing a property deal and you want to sell a flat. You talk to a couple of brokers, 2, 3, 4 brokers, and you tell them that this is your property and this is what you're expecting. Now they make their effort, they contact their network, they get some site visits for a few customers, few prospects, and you finalize a deal. Once you finalize a deal, you pay 1% brokerage to that broker. So that 1% goes to that 1%, and that because of which your 1% returns goes down, essentially, right? Let's assume you were lucky and you found the buyer yourself in your own network. In that case, you will not pay that 1%. The entire money will come to you, and you don't have to pay anything to anyone. But the same thing you take it to, and having said that, the property is same. See, whether you have a broker or not, the property is same, seller is same, location is same, price is same, everything is same. Now take the same thing to mutual funds. The mutual fund scheme is same. Motilal Oswal Mid Cap 30 Fund. The scheme, the stocks they have is the fund manager of the scheme is same. Everything is same. The only thing difference is whether you're going through a mediator or you're going directly to the fund house. Right? Now let's look at it mathematically. Let's say you started investing 25,000 rupees per month in a scheme or a regular plan, and the same amount in a direct plan of the same scheme. For next 30 years, do the same thing. Right? Now, assumption here is you are investing the same amount for next 30 years, which is not practical. You will obviously increase your investments, but for the sake of calculation and understanding, assuming the amount is same, right? Returns in regular plan is say 12%, and returns in direct plan of the same scheme is 13%. Why so? Because you're paying 1% more charges in regular plan, so that essentially decreases your returns by 1% in regular plan. So direct plan returns will be 1% more. Look at the final amount. So difference of about 1.7 crores. This is assuming the amount of SIP is same for next 30 years. Typically, you will increase the amount and whatever your current portfolio size is, so that the gap will be much more. Now, I'm not suggesting in favor of direct plan, nor I'm suggesting against regular plan. I'm just telling you the pros and cons of both. Let me tell you the flip side of direct plans. First of all, do not invest in direct plan just for the sake of saving 1%. I know in my circle there are a lot of people who shifted from regular plan to direct plan in the last 3, 4, 5 years, and they have stopped monitoring their portfolio now, unfortunately. And they openly say that to me, that they have not been able to manage the portfolio the way it was supposed to be managed, and we can see the difference in the returns. Returns are down by 3 to 4 or maybe up to 5% compared to what it was when the advisor was managing it. So just for the sake of saving 1%, you end up losing 4 or 5%. So don't just get influenced by that 1.7 crore or 2 crore or 3 crore figure. It is definitely a big amount, but the point is, it is not wise to lose 3, 4, 5% return just for the sake of saving 1%. So you should go with direct plan only when you're sure that you will be able to devote time and energy. And it's okay if you're not able to devote that. Please delegate that work. It's okay. It's okay to pay 1% to the advisor or to the agent. Right? You might have heard of this saying, penny wise, pound foolish. Make sure you don't get into one of that trap. Yeah. So you need a regular plan when you first of all need advice on creating and monitoring your portfolio, when you need someone to guide you on that, when to buy, when to sell, when to switch. So you need complete guidance. And second, you need back-end support, back-end operations work. Now, what is back-end operational work? KYC, re-KYC, bank mandate, increase your SIP amount, decrease your SIP amount, stop your SIP, invest lump sum, exit. So whatever you instruct that person, he'll do it for you, because he has his own office setup, he or him or her, and they will do it for you. So basically, they are charging you 1% for this backend service and the advice put together. Yeah. So both is correct, be it regular plan or direct plan. You should know what your requirement is. According to that requirement, you should choose one of them. And even if you have moved to direct plan in the last few years or few months, or you're planning to move, and later you realize no, regular plan was better for you, please move back. It's okay. Don't be like, you know, I took this decision to save 1%. Why should I move back to regular plan? It's okay to move back. Yeah, it's about making that final return. That's what is important. Look at a few questions. Any questions on this regular versus direct? I have a couple of other questions in the chat box, not related to this topic though. So one question is, what is the difference between active and passive funds? So Sandeep, active fund means the fund manager is actively researching and choosing which stocks to invest into. Passive fund means they are just copying an index. For example, Sensex is an index or Nifty is an index. So that's the Nifty index fund. So Nifty has got 50 stocks. So the fund manager will just copy those 50 stocks as it is. And whenever there is a change in the composition of Nifty 50, let's say out of 50 stocks, 2 stocks move out of Nifty 50 and 2 new stocks are added, the fund manager will copy paste the same thing. So that's called passive investing. So fund manager is not supposed to use his brain. He's just supposed to copy the index, and that's called passive investing. What's your viewpoint on ESG funds? So ESG is environment, social, and governance fund. So basically, this is again gaining traction for last few years now, especially after in last 1 year. I again believe it's kind of a sectoral fund again, because you're again restricting fund manager to invest in a certain kind of companies and not invest in other companies. And I also believe it is very idealistic to expect any company to be conforming to ESG criteria. It's very stringent criteria if you look at it. You give me any company which you think is ESG compliant, and they'll tell you 5 reasons why it is not. So it's more of a psychological thing that I'm investing in an ESG fund, and all ethical companies I'm investing into. I believe that's really not the case. For the selected mutual funds, it's better to invest in direct or regular plans. So again, that depends on your requirement. I mean, are you able to take out time? You have the expertise first of all in mutual funds, and are you able to take out time to do the research and monitor? If yes, please go with direct plans. If no, you have other many things to take care of in your life, be it your professional or social life, then you can always delegate that work. Yep, Rajesh, I agree with you. Okay, capital gain, good point, Sandeep. Capital gains on shifting from regular to direct plan should also be considered that side. So when you're shifting from regular to direct, it is considered as that you have sold the schemes and you're buying new schemes. So you will attract short-term capital gain tax and long-term capital gain tax as per the applicability, plus exit load also. So if you exit a scheme within 1 year of your investment, there is about 1% of exit load, which the mutual funds company deducts. So please be very careful of that when you are shifting from regular to direct. And even when you're shifting from direct to regular, back to regular, even then the same thing will happen. Yeah. All right. I hope this point is clear. I can move to the next one. How to choose your advisor. Now, luckily, in last about 7 to 8 years, SEBI has come up with various licenses within this advisory industry, which is good for the investor community, because now you have options to choose from, that what kind of advice do you need, what kind of support or service do you need, and based on those various services and license holders available, you can choose your service provider. Right? So I'll just take you all of them one by one. The most common one and the oldest one is mutual fund distributor. So if you are managing your mutual fund through getting a mutual fund portfolio managed through some agent or advisor, most likely that person has got this license called mutual fund distributor, most likely. Yeah. Number one, they make you invest in regular plans. So they will not charge you any fees. They will not cut this check and give it to me, right? They never charge you, and they will never charge you in future also, because they get their commission from the mutual fund company. That's how they make their revenue and profits, right? Example, it can be an individual who's running his own setup. It can be a bank. As I told you, even the bank relationship manager, when he's selling you a scheme, he's a mutual fund distributor and he's investing money in regular plan. And it could be a brokerage house executive also. But just be careful about one conflict of interest here. And before I talk about conflict of interest, let me make this clear. There could be people here who are into in a banking industry, banking jobs, and they are also selling mutual funds to their clients. What I'm trying to share here is more of a structural problem. It's not your problem. It's not your fault. It's more of a structural issue. So there is a clear conflict of interest when it comes to dealing with a relationship manager or any executive of a bank or a brokerage house, because typically their career or their growth is not aligned with your portfolio performance. They all have very high pressure jobs, as I know a few of my friends also in this industry. They're supposed to fulfill their targets every month, every quarter, every year. Targets in terms of how many schemes they're selling. Once they've their target is complete, that's how they get their promotions and incentives and bonuses and all that, and that's how they move on. But the point is, whether you get returns in your portfolio or not, it is immaterial to their career growth. That's how the banking industry has been structured, unfortunately, right? And even if you look at your portfolio after 5 years, let's say you are a long-term investor and you agree with this fact that you should invest in equity market for long term. If you look at your portfolio after 5 years and returns are not there, most likely that fund manager would have left that company and moved to some other company, maybe to some other country or some other city. So you don't have anyone to hold accountable. Whereas when you're dealing with some individual who is running his own setup, his or her own setup, their interests align with your interests, because their business will grow only when you make money, only when you make returns in the long run. Because only then you will get them more money to invest, only then you will give them references. Right? So there the interests are aligned. So just be careful when you're dealing with anyone who is advising you. Just see what are their incentives. How are they going to grow? Are they going to grow with your portfolio, or are they going to grow just by selling you the schemes? Yeah. So there's a clear conflict of interest in my view in this case. Only in case of the executives who are working with a bank or a brokerage house. Another kind of license is called SEBI Registered Investment Advisor. We also call it RIA, Registered Investment Advisor. They make you invest in direct plans, but they charge you both fees and commission. For example, they will tell you, give me the X amount of fees, which is like one-time registration or maybe annual, depends on person to person, and a commission rate, let's say 0.5% or 0.6%, 0.7%, whatever it could be, based on your portfolio size, right? Now, in this case, you are paying less than the regular plan, most likely, but a little higher than, but more than the direct plan. So your charges are anywhere between direct plan charges and regular plan charges, right? In this case also, they do everything for you. They manage your account. They choose the schemes for you. They monitor it on a regular basis. They do all the back-end office work for you. Same as MFD. So be it MFD or SEBI registered investment advisor, they are doing everything for you. You are delegating the work completely, but the difference is the way they charge you money. Yeah. Third one, SEBI registered research analyst. This is a license, for example, I have got, but I don't deal into mutual fund advisory at all. So there is no biasness coming here anyway. They can charge only a fixed fee. So let's say there is a research analyst, a registered research analyst who is advising on mutual funds. They can only charge you a fixed fee, let's say annual fees, which you have to renew every year if you want to continue getting their recommendations. And it is irrespective of your portfolio size. So whether you have a 10 lakh rupees portfolio or a 50 lakhs or a 10 crore or a 50 crore, their fees will remain the same. It's like going to a doctor, whether you are a rich person or a middle class or a lower middle class, the fees of the doctor is the same, right? Similarly, you go to them, you pay them the fee, you get the advisory, and then you implement it on your own. You do not get any kind of back office support in this case. They only manage, they only suggest you the scheme, they give you the advice or information, and you're supposed to implement that information at your end. That's how, so basically you invest in direct plan in case of registered research analyst, right? Because you are getting the advice, you're paying the fees, and then you can go and invest directly. I'll share the name of the platforms in the next slide. So for example, you have a portfolio of, let's say, 1 CR, example, 1% charges more in regular plan means 1 lakh rupees more you are paying every year. Yeah. If you are a portfolio of 1 crore, you're investing in regular plan compared to direct plan, you're paying 1 lakh rupees more. Why? Because you're getting service from that MFD or the RIA. But if you are paying, let's say, going with the RA, you are maybe paying 10,000, 15,000, 20,000 rupees instead of paying 1 lakh rupees and getting the same kind of advice and information. Just that you have to do the back end work at your end. The operational work has to be done by you. That's the difference. I hope that made sense. And the fourth and the last category of advisory or services available is called robo advisory. Again, it's a robot advisory. Basically, it's a AI based mechanism. It's a website in a way which makes you invest again in regular plans. Some of the names you might have heard: Scriptbox, My Universe, Funds India, where you have a very user friendly interface. You have a most likely relationship manager also who's dealing with you, but it's all virtual, right? You have a customer care, you have a support team and everything. You can build your profile there. You can, they ask some questions based on your risk profile and all, then they suggest you which schemes you should invest into, and they keep suggesting you when to change and when to switch, right? Now, within this robo advisory, it's not exactly robo advisory, but you have these HDFC Securities, ICICI Securities, and Axis Securities kind of firms as well, where they give you a very nice interface, but they make you invest in regular plan. Yeah. So this is broadly what you have in front of you as an option, whether you want to go with MFD or SEBI registered investment advisor or research analyst or a robo advisory platform. Most likely, most of you would be investing through MFD. That's what I believe. Anyway, let me ask this question to you. Whom are you investing with right now? If you are managing your portfolio through someone, are you investing through a MFD or a RIA or a RA, or you are going with any of these robo advisory platforms? You can write an answer in the chat box. MFD, MFD, MFD. So far, all MFD. Anyone else? Whom are you investing with? Or are you investing direct? You can write direct in that case. Are you investing directly through mutual fund houses? If you're not taking any advice from anyone. MFD. Share Khan. So Share Khan is like, I told you the name of these HDFC Securities and all, same thing. Share Khan, MFD. Some people are investing directly as well. MFD and direct. So you're doing both. Rarely direct. Investment advisor and direct. Got it. Got it. Perfect. Perfect. So we have a mix of people here. So by the way, those who are investing direct or plan to invest direct, these are some of the names of the website. The most common ones, it's not an exhaustive list, but the most common ones which are doing well: Kuvera, Grow, the Coin, Paytm Money, ET Money. So basically, you can go to these platforms, create your profile, import your data. There's a step-by-step process. You can import all your mutual fund data there, and you can start your SIPs and all the investments through that platform. So everything comes at one place, and they make you invest only in direct plans. They don't have an option of regular plans on their website, right? And they don't charge anything. They all are funded startups, and they are just creating that database and the customer base. And some of them have started their advisory services, for which you need to pay separately if you want service. I'm not sure which ones, but I think a couple of them have done that, and they have other, data science and other ways to make their money. Yeah. Let me look at a few questions now. I think I missed a few of them earlier. Yeah, I think Rakesh, I answered the question. How do they make money? So they will eventually make money, right? They are just the way any startup does. They just create the customer base, and eventually they will start charging me. How is Axis Midcap and Axis Blue Chip Fund mutual funds? Because I'm sorry, I would not be able to comment on any particular mutual fund scheme, because that will turn into a kind of advisory. See, the problem with these kind of advisory, I mean, let's say you ask me names of a few schemes, and even if I give you a few schemes today, the point is exiting a scheme at the right time is equally important, if not more, as it is to choose the right scheme. So even if you get to know which schemes are good today, that does not mean you can forget that portfolio for next 5, 10, 15 years. No. A lot of people come and ask me, tell me 5 schemes which I can invest in for next 10 years. So I tell them these 5 schemes are good today. They may remain good for next 10 years. They may not. So you cannot, you are supposed to buy and forget the money. To buy and forget does not mean you're first forgetting your portfolio monitoring at all altogether. You're forgetting to use that money. You're investing the money for long term. That's what buy and forget means. It doesn't mean you forget your portfolio. Yeah. So whenever you ask this question to anyone, not just me, please be very careful that you're not getting the other side of the coin. You're not getting where to exit. Yeah. I think Srinivas, I answered your question. Zerodha Coin, all these names I have given you now, these are direct platforms. MFD or stockbroker company recommend ULIP with multi-year premium commitment, stating that these assured returns are much better than the mutual fund returns long term. So I think that's a statement rather than a question. So ULIP or any kind of insurance plan, which is a mix of investment and insurance, is a big no. If you want to go with insurance, it should be pure insurance, term plan, medical plan. So anything else is making them money, not you, for sure. Is it advisable to invest in SWP schemes if good criteria to follow? SWP means systematic withdrawal plan. It's not SWP schemes, Suresh. It's not that SWP particular kind of schemes. It's a way to withdraw money. The way you have SIP, SWP is the opposite of SIP. What is happening in SIP? Every month you're investing something. SWP is systematic withdrawal plan. Instead of exiting a scheme at once, you're telling the fund house, exit the scheme for a period of next 12 months. Divide by one by 12 and exit one by one gradually over a period of 12 months. That's SWP. It's not a type of scheme, it's a way to withdraw the money. If mutual funds usually calculate cumulative returns, but in actual no accumulation happens, how? Johnson, I'm not sure if I got your question. Mutual funds usually calculate cumulative returns, but in actual there is no accumulation. Why there is no accumulation? If you're investing, let's say, in a scheme for 5 years and that scheme says it has got 17% returns compounded annually, example, you actually have got 17% returns in that case. Okay, next one. Fund manager, very interesting one. The person responsible for taking all the investment decisions, right? I shared with you in the beginning. Fund manager is the one who is the topmost guy in any particular scheme, and he's the one who will take the final decision making on which scheme they're supposed to invest into, right? So, skin in the game. Now, before I talk about skin in the game, can you take a guess what is the kind of remuneration fund managers have in India? Annual remuneration of a fund manager in India, including bonus, incentive, everything. How much do you think they earn? What are their salaries like? Annual income of a fund manager in India. Take a wild guess. The topmost guy of any mutual fund scheme. So every mutual fund house, for example, HDFC mutual fund will have multiple fund managers because they have multiple schemes and every scheme has got a fund manager. So what do you think is the remuneration of a fund manager in India? 3 to 5 crore, 1.5 crore, 1.2 crores, 50 lakhs, 2 crores. Okay. Anyone else? Any other guesses? You guys are not too far. Take a wild guess. Just think I'll tell you why am I talking about it. I'm not saying that it's a bad, they should not earn this one and that one. I'm not going in that direction. I'm just coming to a point there. 2 crores, 10 crore plus, 75 lakhs, variable based on fund returns. Okay. So typically the salary of a fund manager in India is between 2 to 10 crores, including incentive plus everything, right? Total package. For a new fund manager, someone who has just entered into the industry as a fund manager, the salary could be between 50 lakhs to 2 crores initially, but within like 2, 3, 4 years, they cross 2 CR for sure. And I'm sure this 10 CR will also go much beyond that. Maybe for a couple of them have more than 10 CR also. Now, the point is not that they're making too much money or a lot of money. I'm sure they're making what they deserve. That's not the point. The point is, this is the kind of salaries they have. I believe they have no excuse that they're not able to save enough to invest. I'm sure they're saving enough and I'm sure they're investing well. But if they're not investing in the schemes which they're managing, that definitely puts a question mark on the scheme, because they are the one who are choosing the stocks in the scheme. They are the one who are putting their life, their day in, day out in the research. If that's their profession, that's their full-time job. If they're not confident about the kind of the full-time job they are doing, then that definitely makes me uncomfortable. They must have, I'm not saying everything that they should invest in that scheme, but they should have some money in that scheme. Yeah, some sizable money given the kind of salaries they have. So I see look at investments done by these three categories of people. Key managerial personnel, that is the KMP or the senior management of the company, of the mutual fund company, fund manager or the fund managers. A scheme can have more than one fund manager also. Sometimes it has fund managers, and board of directors. AMC is asset management company. The mutual fund company is also called AMC. So all these three people put together, what is their investment? That is what I want to look at. Because even the KMPs and the board of directors are crucial for the scheme, because they are the one who hire the fund manager. So if they have their own stake in that scheme, will do all the due diligence to hire the right fund manager and not just ask some of their known people to come and sit on the seat. Yeah. And all this information is available in the scheme information document. It's available there, right? Let's look at a couple of examples. Edelweiss large cap fund. Let's look at the investments by these three people put together in this particular. Just a second. So this is a scheme information document for Edelweiss large cap fund. I will just do a control F of this word called aggregate, and I'll search for a particular table which will show me the data. It's a 119-page document. You're not supposed to go through the entire document. Just look at this aggregate investment as on 31st March 2021. Look at this. Total investment is 70,000 plus 70, 34,000 rupees, 35,000 rupees only, which is not impressive for sure. Right, 35,000 rupees put together by all the three categories, all the set of this bunch of people put together. Yeah. Let me show you one example. DSP Midcap Fund. Let me open the document. I have downloaded it already. DSP Midcap Fund. Just give me a second. Here it is. Again, I'll look for the word aggregate. Look at this. Investment as on March 31st, 2021 in amount in crores. Always look at the units. Look at this, 25.5 crores plus 94 lakhs plus 1.56 crores. That's sizable, like 27, 28 rupees. So having said that, I'm not saying go and invest in the scheme. This is one of the parameters we are looking at, not the only parameter. So there are cases when the scheme, all these people have put good enough money in the scheme, but still it is not performing. So see, understand, there are two pillars to this. One is management, one is the fund managers or the management's integrity. The second is their capability. They are two different things. Don't mix them. So when they're investing their own money into that, that's called integrity. But are they capable also? That's also a point. If they're not capable of doing the right research, then their money will also go down, my money will also go down. So don't just go and invest in the, let's say, DSP Midcap Fund because you can see a good amount of investment there. Right? So I'm just telling you because I don't want people to go and buy this particular scheme based on this one data. I know a lot of people do that. I'm just telling you all this so that you can at least check this in your own portfolios, all these data points. Yeah, I hope this made sense. Let me look at the questions. Who is the top ranking mutual fund manager? Who is the top ranking, which is the top ranking mutual fund? So first of all, stop looking at top ranking mutual fund manager. There's no ranking as such. And there is this, what do you call it, celebrity status of a few fund managers. Don't get influenced by that. I know a lot of celebrity fund managers who did well at a certain point in time. Now they're doing very bad in terms of the performance. So just because a fund manager has done well in the past does not mean that you should go and invest in that scheme. Fine, that could be one of the parameters to look at. But based on that itself, you cannot just invest in the scheme. Right. And similarly with top ranking mutual fund house or mutual fund scheme, the ranking keeps changing depending on their performance. So there was time when HDFC mutual fund was doing well across most of the categories. Today it is doing bad across most of the categories. It's like one of the bottom most schemes. Yeah, that could be the case with any other mutual fund house. I think I answered this question. How do we know the information about schemes fund manager is investing? So we covered that scheme information document. Suresh, I think I answered your question as well. Sandeep is saying, I think this came up in Franklin Templeton case. Manager sold funds before closure. Yes, the Franklin case, first of all, it's a debt mutual fund case plus be it Franklin Covey or any these cases which come up like one in 20-25 years. I mean, there are different kinds of issues, right? And not that in all these cases every investor gets impacted and the entire money, the entire portfolio of the investor will get impacted. That will not happen. So why am I saying this? Because a lot of investors again question me and ask me that, you know, why should we, how do we safeguard ourselves from these kind of fraud? My answer is actually no solution to that. SEBI is there. They have taken some very good measures in the last few years. They are still taking. You know, companies will keep on coming up with new ways to con people. You can't help it. You have to, you know, deal with that. You have to take it in your stride. It's not that you're putting all your money into one thing in one scheme and then you're losing everything out. That's not happening, right? So just these outlier events cannot take you away from making your financial goals and fulfilling them. So let it be. I mean, whatever has happened, and SEBI has taken corrective measures to get that money also back to the investors, but should not impact your journey in the equity market. Yeah, SEBI has penalized them. Yeah, these events are always bigger, better, faster, and more. Yeah, that's Harishan. So it will be bigger because, you know, what was 1,000 crore rupees was a big amount 20 years back. It is not. Another 10 years online, it will be 5,000 or 10,000 crores will not be a big amount, even 1 lakh crore maybe. Yeah. Any other questions you have so far? How safe are pension funds where we invest for the rest of our life? So pension funds, any specific scheme you can name. So this is, I mean, mutual fund is a separate thing and a pension fund is a separate thing. Pension funds are usually all debt oriented schemes, so they are safe investments. So it's not really equity most of the time. View on index funds. So I believe when it comes to index funds, I have noticed that large cap schemes have not been able to perform, or may not outperform the index funds in the next few, in a foreseeable future. But when it comes to mid cap and small cap category, there is a lot of growth left in actively managed funds compared to index funds. Just look at the performance, you'll know that. So for the large cap category, I do believe that index fund is a better choice. But for mid cap and small cap category, I believe active funds have a lot of steam in them. Can you name top 5 mutual fund categories or schemes? Schemes, as I was just telling someone, I will not name the schemes because even if I name the schemes, that does not help. It may do more harm than benefit. You have to exit also at the right time. Categories, when you talk about, as I was sharing in the sectoral that categories slide, just invest your money across large cap, mid cap, and small cap. These 3 categories, enough. There is no need to go for any other fancy category. I mean, the way you diversify depends on your comfort level and your planning, but these 3 categories are more than enough. See, a couple of people are talking about flexi cap. Flexi cap is also fine, but I find them cumbersome when it comes to financial goals. So now the problem is 99% of the investors do not care about having a financial plan. They don't have it. So when you have a financial plan and you know how much returns you need to make to get reach where, and then when you monitor your portfolio, you will find that monitoring and taking decisions on flexi cap or multi cap kind of schemes is tougher compared to taking decisions on a pure mid cap, pure small cap, or a pure large cap scheme. That's my view. I mean, if you are happy with the returns and you're happy with the flexi cap scheme, you can continue with that. Difference between small case versus mutual funds and which one is better option. See, small case is more like a convenience platform. In mutual funds, you have an option to SIP, do SIP. Automatically your money gets deducted from your account and goes to the scheme. In stocks, you don't have that option. You have to manually go to your mobile app or your screen and do that. To avoid that manual work, they have introduced small cap. It's just more of a small cap is not like a different kind of a product. It's just a convenience platform. It's not that small cap is better than mutual fund or mutual fund is better than small cap. Small cap is a bunch of stocks. Mutual fund is also a bunch of stocks. Just as small cap has a relatively lower number of stocks compared to a mutual fund. All right. Let me move ahead. I think this is what I had to share with you today. A couple of things before I move forward from here. if you are interested, I have a Telegram channel. I'm just sharing a link in the chat box where we share these nuggets on mutual funds, stocks, personal finance, taxation, real estate, gold. We just share small articles or posts or videos, which can be helpful for you in terms of your investments. So if you want, I have shared the link in the chat box. You can click on there and subscribe to that. Now, moving forward, as Nirlep was sharing in the beginning, we have a program which we want to introduce to you. And here is a question which I have for you before I move forward. How would it be if I train you to gain mutual fund expertise so that you can fulfill your financial goals? I just want to know how many people out of you are interested to know about this program. How many of you are interested to learn more about how to choose a mutual fund scheme, how to form your portfolio, how many schemes you should have, how you should allocate, how you should exit, how frequently you should monitor, which schemes to invest into, what not to invest into. So you have to understand everything with respect to equity mutual fund portfolio. That's what this I'm going to share about now. All right, got it. Awesome. Quite a few people interested. So let me introduce you to something called Mutual Fund Excellence Program. It's a 3 days live workshop, not recorded courses, it's live workshop, in which we will shortlist mutual fund schemes during the live sessions. Practically, I will show you on the Excel sheet. I'll create a proper portfolio, create a category, I'll shortlist schemes in front of you using tools which you will learn there, right? You will also learn the art of monitoring your portfolio at appropriate intervals. Knowing when to sell is a tougher decision compared to knowing what to buy, right? So shortlisting schemes is still simpler compared to taking a call on when to sell. That's what we look at in detail. And having said that, some of you might say that, you have an advisor already and you don't really want to do it yourself, which is perfectly fine. As I said, regular plan has its own benefits. I told you about that in today's session. But just look at the kind of questions you ask your advisor. Typical questions. Why are we not getting returns from this scheme? Or why is my portfolio not performing? Why are we getting 12% returns? Why not 15% returns? What kind of returns do you expect in future? So these are very typical questions. Some people, when they don't get returns, I should have invested in FD better than this. Why am I investing in equity mutual funds at all? So instead of that, if you start asking them, why have you selected this scheme? This scheme has these 3 problems. What is your view on that? I'm not asking you to break them or make them wrong or argue with them. I'm just asking you to have a meaningful conversation, a healthy debate, or maybe tell them, why are we not investing in this scheme? This scheme seems to be very good based on all these parameters, right? Even when the returns are not coming, you will know what is happening and you will not be blind to it. Most of the people are like, I don't know what is happening in my mutual fund portfolio. My advisor is managing it and I'm happy with them. Good that you're happy with them, but your financial life is dependent on that. Whether you will fulfill your financial goals or not, whether you will create that wealth or not, that is dependent on that portfolio. I'm not saying don't take advice or don't take help. Do take that, but at least you should know what is happening in that. You should be able to have a meaningful conversation with your advisor, right? So that's what you will be able to do. Now I'll talk about the bonuses in a couple of slides. There will be a dedicated WhatsApp group for queries in this program. So every batch we have a dedicated WhatsApp group, and I stay in that group for 9 days. So 3 days program and another for 7 days I stay in that group, right? This program is only on equity mutual funds. I will not be able to cover anything on debt and hybrid mutual funds. I'm just telling this upfront and heads up. It's a complete different domain when it comes to debt mutual fund selection. It cannot be covered in the 3-day program. So this program is only for your equity mutual fund portfolio. Yep. So the next dates which we are coming up is the coming Friday. We are starting 30th July. 3-day program, 30th July, 31st July, and 1st August. Timing is all IST, Indian Standard Time, 8:30 p.m. to 10:45 p.m., which I believe is 6 p.m. there. Right? So 6 p.m. to 8:15 p.m. all the 3 days, right? And if you miss the sessions, you will get the recordings, access for 7 days. So 1st August is the day program gets over. I remain in the WhatsApp group till 8th August. The access to the recording also is there till 8th August. And then the access will be taken away. So you have the live sessions. I advise you, if you are going ahead, you should go with that live sessions. In case you miss it, you can watch the recordings as well. Just to give you an idea brief about what the program will cover, you can divide it into starters, main course, and desserts. So we'll start with very basics. Even if someone is totally new to the program, new to the concept, they will come on equal footing on day one itself. Then we'll start looking at how to shortlist mutual fund schemes, the tools to shortlist that. Then the day two, we will start actual shortlisting of mutual fund schemes. We'll look at how to create your portfolio, how many schemes you should have, and other parameters to look at, how to monitor your portfolio, how frequently you should monitor, and what you should check, when to sell, the taxation part. Then we'll work on a sample portfolio. Most of you, I believe, are already investing in mutual funds. What should you do with your existing schemes? Should you keep on buying? Should you sell? Should you hold? So that clarity will come with this working on a sample portfolio. I'll talk about some other factors. For example, funds. I'll share a brief about international funds also, exit load, NFOs, how to move from regular to direct or vice versa. So all those things will be covered in this topic. And then how to choose advisor and which platform to use. So this is the basic structure of the program. So this is what you get. This program is worth 1,999. The 3 bonuses I was talking about, the 6,000 worth of bonuses, you get an ebook on how to avoid medical claim rejections. A lot of people have suffered this in the last 1 year. They had medical insurance, but they did not get the complete money, or they did not get it at all. So this simple ebook can save you that. Checklist on choosing the right term plan. A lot of you might have term plan, but still there are a lot of factors, a lot of clauses you don't take care of. So this ebook will cover that. And ebook on how to improve your credit score. And the most important and the most exciting part of this program is quiz. So every day, day 1, day 2, day 3, after the session, we have a live quiz in which I ask questions based on whatever you learned on that day. It is a timed quiz and a scored quiz. All 3 days quizzes scores are added, and the top 10 scorers get 600 rupees each as cash in their bank account. So just for the engagement part and learning part, and just to also check that whether you understood the concept or not. You may not participate in the quiz to win the cash prize. It's not a very big amount, but you should still participate in the quiz to see whether you understood the concept. So this is total worth 8,099 rupees, but you don't have to pay 8,099 rupees. 599 is the price on my website. If you go and check that, this is the price which people pay and they register for the program. Just a small token of thanks, appreciation, and a very small gesture. We will give it for 499 rupees to your chapter, so ICA chapter of Doha. As Nilep shared with you in the beginning, he will be sharing, the team will be sharing a Google form with you. You have to express your interest there with your details, and then they will maybe share the details with me. I'm not sure exactly how the backend will work, but they'll get back to you after this session.
Yeah, thank you, Anupamji, and sorry for interruption. Now, in continuation of this, first of all, really a very great gesture by Anupamji. This is a highly successful program, and you've been very kind enough to offer to our chapter member at the discounted price. So friends, we are 80 who is attending this session now. Idea is to spread this information to other non-attendees, but only for the chapter members also. So we'll make a Google form, and in which please express your interest by sharing your email ID and phone number, which will in turn share with Anupam sir. And we will keep this open for next 2 days or so. So by then we would be able to share this information, name, email ID, and the phone number. So
that's right.
Yeah. Thank you, sir. Please go ahead.
Yeah. So just a couple of things more before I answer your questions in the chat box regarding the program, and I'll answer other questions also which I might have missed during what we learned today. So Piyush did the program last year in December 2020, and he gave his views found it very simple, the entire structure of the program. And Vivek is a professor with IIM Lucknow. He recommends this to everyone, be it a beginner or a pro investor. Kiran Reddy said he was overwhelmed by the number of schemes in the market and was blindly trusting the mutual fund ratings. If you look at Morningstar, Value Research, all they have got mutual fund ratings. Now, again, if you just follow the ratings and you can make money in mutual funds, then everyone would have, there would have been no poverty in India. Everyone would have made money. There would be no investment in FDs and RDs and PPF, right? So just following the ratings, if you could have made money, then everyone would have become rich. So now he can confidently build his own portfolio, and he found the framework very crisp and clear. That's what his feedback was. I'll play a 4-minute video, 4 people from different walks of life, from student to homemaker to a mutual fund advisor who also, in every batch I have like around 8 to 10 mutual fund advisors who take this course, so to help their clients to serve better. So I have video recommendations from all these people, just in a small video of 4 minutes from these 4 people.
Hi, my name is Parth Nishal Trivedi. I'm currently in my last year of undergraduation in Bangalore. I'm a student of Anupam Sir in his Mutual Funds Excellence program. The structure of the program was outstanding and the content was in-depth as well as crisp that even a non-investor will become an expert in understanding mutual funds after the program. The explanation and demonstration of building a sample portfolio has helped in getting a theoretical as well as a practical point of view. Anupam Sir has been an exceptional teacher by sharing his honest thoughts and clarifying all our doubts with proper reasoning during the 3-day session. Post session 2, Sir has been actively clearing all our doubts through WhatsApp individually and giving in-depth answers to each person. I would highly recommend the course to each and every person, despite being an investor or not. Thank you so much, Sir, for helping me start my investment journey in such an informed manner.
Hi, my name is Vinayak Kini. I am based in Bangalore. I have been in the financial services industry for more than 20 years now. I have been investing in mutual funds for a long time, but one thing I have been in search of is a strong framework to manage my mutual fund investments, whether it involves the selection of a fund, creating a portfolio, reviewing the performance of my funds, or even exiting a fund. Anupam's Mutual Fund Excellence Program addressed exactly this need. In a world where there is an overload of information, it focused on the key aspects of making successful equity mutual fund investments through a robust and a repeatable process. He also emphasized many times during the program that discipline is the key to success. I encourage everybody, whether you're a beginner or an experienced investor, or you simply have a passing interest in equity mutual funds, to attend the program. It will enhance your understanding of equity mutual funds and make you a more confident investor. Thank you.
Hi, my name is Pooja Prabha and I work for City Corp Pune, and I did this Mutual Fund Excellence program with Anupam, and I would highly recommend to everyone. It is a one-stop solution for all your mutual fund queries and understandings. I also highly recommend this for females because we generally rely on our male counterparts to take the financial decisions for us, and especially when it comes to investing, right? So this program really helps to get in-depth and understanding of mutual funds, and you can just get kick-started from the day one. So I highly recommend this program, and thank you so much, Anupam, for having such platform for all of us.
Hello, I am Krishna Mohta, a mutual fund distributor and financial advisor from Akola, Maharashtra. So my review is going to be from a mutual fund distributor's point of view. Socrates was the wisest man in Athens, not because of how much he knew, but he was the only one who understood that how much he did not know. Now, as a distributor, I wanted to unlearn and relearn about mutual funds. And hence I came across this program of Anupam Rungta's Mutual Fund Excellence Program. A lot of information is flowing on in the internet, YouTube. But what is more important is knowledge. And hence go after knowledge and not information. And Anupam Rungta's Mutual Fund Excellence Program is one such program which focuses on knowledge and not flow of information. The program is brilliantly structured and gives a lot of clarity on a lot of mutual fund topics. Me as a distributor, I am very lucky that I got to go through this program, because now I am able to implement these strategies for my clientele. And I hope to see that I devise a nice framework and generate more returns for my clients. So this program is not only important for investors, but also for all the mutual fund distributors to become a better version of yourself. Thank you, Anupam Rungta, for such an enlightening program.
All right, now I can take up your questions. I can see it in the chat box. Do you have any program on debt mutual fund? So we are developing a program on debt mutual fund, but that may take some time. It will take at least around 2 to 3 months. So the moment we do that, it will be there on our website. But right now we don't have any program on balance funds. Balance funds, typically, I'll not recommend to go with balance funds or hybrid funds. So my view on that is, let's say I want to invest, I have a proper financial plan and I want to invest X amount, X percentage in equity and Y percentage in debt. So when I'm clear about this balance between my investments into equity and debt, I'll prefer to go with a pure equity scheme and a pure debt scheme. Mixing up the two and investing in a balanced or hybrid fund does not yield superior returns, or does not even give me that flexibility to move out and move in move out and move in from equity and debt. And the expense ratio, by the way, is higher for a hybrid plan compared to what it should be for a mixture of debt and equity. So there are multiple factors behind that, but it does not really, it makes my financial planning complex. So once I'm clear what I want to do in terms of debt versus equity, the allocation, rather go with pure debt and pure equity. Don't go with hybrid and balanced funds. That's what my opinion is. What's your opinion on IFO? Are you asking about NFO, Mr. Chandra, the new fund offer? I didn't get what's IFO. NFO is new funds. It's like the way you have IPO, similarly, yeah, NFO, right? So again, NFO, the problem is there is no past data. There's no performance available. So why would I go with that? So, see, please understand, when these new NFOs come, all these mutual fund companies will do very good marketing. They're supposed to do good marketing and supposed to convince you and impress you that this is a new kind of a fund, first ever in India, and this kind of investment they will do, this sector and this fund manager and this and that. So they know how to do marketing. They're supposed to be good at it. But I have hundreds of schemes available in the market with all the data available and the performance. Why would I go with NFO? Yeah. So go see, when the market is bullish, number of NFOs will increase and number of IPOs will also increase. But it's not about what is hot right now. It's about what is sustainable. Is it necessary for your person attending your program to have financial knowledge? Sunil, no. So as I shared a few minutes back, this program will start from very, very basic. So I have got, again, every batch has got some housewife and homemakers, students and retired people who have no background of finance or mutual funds. So even they are able to understand and implement the way they are supposed to. So this program, mutual fund, is actually supposed to be very simple. It is actually very, very simple. The kind of information which is there on internet, it might make it look cumbersome and complex, but it is actually very simple to form a portfolio and to monitor it at regular intervals. It's not like stock investing. Stock investing requires typically higher efforts compared to monitoring or managing a mutual fund portfolio. Any other questions you have regarding what we learned today? Anything, any conceptual question you might have regarding what you learned today or regarding the program, you can ask me. What is the ideal breakdown between mutual funds and equity investments according to you? So Rajesh, again, there is no ideal breakdown. It varies from person to person. Depends on how confident are you on your research or maybe your advisor's research in mutual funds and equity. If your confidence is higher in mutual funds, invest more in mutual funds or invest only in mutual funds. If your confidence is there in equity direct stocks, do that. There is no standard answer that invest 50-50 or invest 40-60 or 70-30. ऐसा कोई answer नहीं है. So that completely depends on your comfort level. So if you look at the characteristics of both the investments, stock investments are supposed to be more fluctuating and more volatile compared to a mutual fund. So that's one thing you should be comfortable with. They are supposed to be more volatile. A well-researched stock portfolio is supposed to give higher returns also compared to a well-researched mutual fund portfolio. But that is just the end result. The point is, are you doing that effort, making that effort to get those higher returns? It's not that returns में बहुत ज़्यादा difference आता है. It's not that huge differences there, but you are anyway able to beat the inflation and fulfill your financial goals even through mutual funds. So I typically suggest, if you are a new investor, if you're just starting your journey into equity market, start with mutual funds. Over a period of time, if you are comfortable with moving to equity, start small and then see if it suits you. Most of the time, it doesn't suit most of the investors, the direct stock investors. Yeah, so you have to take an informed decision based on your awareness and your understanding. There's no indexation benefits on capital gains. So debt funds. So debt funds, so it's not a short answer. You can do one thing and go on my website, anupamrungta.com, and there's an article on taxation in mutual funds. which talks about taxation on equity and mutual fund. Complete, all the details are there. I'm just sharing the link. Just a second. Let me share the link. Website. You can just go there and you can find the article on the homepage itself. You just go through that article, that will give you all the answers on taxation.
Thank you, Anupam. I think one of the questions that has been raised on the chat, you have answered almost everything. Thanks for that. And once again, thanks, for this interesting and thought-provoking session. I think we all have a lot of takeaways from today's session. And thanks for the offer made specific for our chapter members. With this, I hand over the session to my ex-colleague CA Devki to proceed further.
Sure. Thank you, Arun. Thank you, Nirlep. Thank you, Vignesh. Thank you, the entire team, for inviting me and for listening out to me for 1.5 hours. So that's a great honor. I hope this added value to your investing journey, and you'll be able to do something out of whatever you learned today.
Yes. And then please be with us for another 2 more minutes.
Sure.
Thanks, Arun. Dear members and guests, I hope you all have enjoyed today's webinar. It is my privilege and honor now to give a vote of thanks to all those who helped make this webinar a successful and memorable one. First and foremost, our sincere thanks to chief guest of today's evening, Hemant Kumar Dwivedi ji, for taking time away from his busy schedule and gracing the occasion. Doha chapter of ICI will always be indebted for your support and guidance, sir. What an insightful session, which made us think smartly while investing in mutual funds. My earnest thanks to our esteemed speaker, Mr. Anupam Rungta ji, for enlightening us as to how to sort listing the funds, how to choose the advisors, funds managers, etc. But sir, I am still finding that 1 crore, which you said at the start of your presentation. On behalf of Doha chapter of ICI, we would like to present a certificate of gratitude to Mr. Anupam Rungta. Now, may I request CA Vignesh to please project the certificate of gratitude. Thanks, Vignesh. Our sincere thanks to annual gold sponsor, Mauritian, Aster Medical Center, Protiviti, and EAY, and silver sponsor, Creston SPP Chartered Accountants, KPMG, Oracle, and Focus, for providing their support to carry out chapter activities during this difficult time. I would like to thank entire executive committee, subcommittee, and media partners for their tireless efforts and support. Last but not the least, my dear members, as I always used to say, you are our inspiration and motivation. And without your support, we can't keep our chapter flag high. I would like to thank each member of Doha chapter of ICI for providing their unconditional love towards XCOM. Thanks once again. Stay safe, stay healthy, and good night. Thank you.
Thank you.
Thank you, everyone.
Thanks, Devki, and thanks.